You're live.
Hi, everyone. Apparently this is my show that I didn't know it was going to be my show, but Ahmed is the one who organized this great event. Thank you very much, Ahmed. And this is on behalf of the NICAR CGBN group. So we are being recorded so that future use, if you're interested in some of these hot topics in commercial real estate. And if you have any questions, we are going to have a question and answer session as well as a networking session afterwards. So here's sort of the format and what we're going to be doing today. We have three panelists today. It will be Andy, Bill, and then Bill that will be presenting today. Each will talk about their topics. Andy is going to talk about some of his experience. Excuse me for a second. I'm going to change the view. In the office workspace. Bill, we have two different Bills. So Bill Price, who is a local attorney, he will be talking about the EB5 program, and Bill Kenton will be wrapping it up with an overall view of hot topics. He's the managing commercial broker at King Commercial. So we will have questions. We are going to save them to the end, and each presenter will talk for about 10 minutes. And you are welcome to put all your questions in the chat session or wait till the live portion or the question answer session to ask. So I will be monitoring those. And so feel free to use the chat, not just for questions, but if you want to submit your contact info at the end, you can download the chat and save everyone's contact information. And then after that, when we have a networking session, we'll have everyone introduce themselves with, what their role is and perhaps what their needs and wants are. And if there's anything else that you would like to see in our future sessions in terms of presenters and talking about different global events. After this month, the next month, we plan on talking about Canada. So more details are forthcoming on that. And I look forward to hearing everyone's presentation. So we are, without much ado, we're going to start with Andy. And you go ahead and take the mic, Andy.
Thank you very much, Teresa, and thanks, Ahmed, for organizing. And thank you all for the participants for joining NICAR Commercial Global Business Network's Hot Topics webinar. We're excited to be presenting for you today, and hopefully you'll learn a lot and ask us some interesting questions that will help us learn alongside you. I'm Andy Velkney. I'm NICAR's president-elect and the former chair of the Commercial Global Business Network. I'm a senior vice president at Caton Commercial, where I work primarily with innovative commercial real estate concepts, including co-working and co-living, and do some urban retail and restaurant work as well. In addition, I'm the vice president of workplace solutions for the central region of the US for Upflex, which is a tech firm with a worldwide network of co-working spaces that span 1,600 cities and 675 brands. In a way, it's an Airbnb of flex office space globally. In the last 16 months, we've experienced a lot as an industry, and it's been really tough on several sectors, especially the office sector and the urban retail sector, which in city centers benefit each other or conversely suffer together. As things come out of the pandemic and the center cities are regaining some life and vitality, things are changing quite drastically. The world we lived in before a year and a half ago is no longer the world we'll inhabit moving forward. What I'll be talking about is those effects and how the new office environment is developing and how that partially affects as well the urban retail in these, office-centric downtowns. So as we know, and most of you here, if not all, went to a work from home movement because of the pandemic. And that happened quite quickly, last March of 2020, previous March, when things began shutting down, instantly, Zoom became the go-to tool, or Microsoft Teams or Google Chat, whatever it may be. But this, was a rapid fire reaction to the pandemic. And it was embraced by many, or most, or some, depends who you talk to, depends on the day, perhaps. There were quite a few challenges in the work from home movement. For many people, they had inadequate space or they had inadequate technology. internet that wasn't strong enough, that didn't allow them to properly chat or have streams going for themselves, as well as their children who were doing online schooling, or they just had children or pets as coworkers, which oftentimes was not good if somebody's cat jumped on their lap mid-meeting. But at the same time, there were advantages. The advantages were that there was no commute. It was better for the environment, that people weren't burning gasoline, driving into the cities. So, it wasn't all bad. In fact, some people embraced it, others maybe not so much. The stats were quite staggering when at a certain point in time, less than 10% of downtown office workers were going into the office. And, that had a huge effect on everything from transportation to retailers. You need office workers, simply put, to buy coffee, to buy sandwiches, to use the dry cleaners. All those things suffered tremendously. And, the rents that they were paying weren't justifiable if they weren't, producing the volume they needed. From a revenue standpoint, which was virtually impossible when you have 10% of the expected folks in a downtown at a certain time. Then you add into the lack of tourism and the lack of people from elsewhere in these cities, and you had a very, very difficult scenario. Now, as things come back, some stats show about 50% of office workers are coming in at least semi-regularly, which means several times a week, perhaps. It could be on Tuesdays and Thursdays. It all depends on the company, all depends on the industry, really. Certain industries rely more on collaboration to get work done. Others really have a strong and company culture of training and mentorship. It's really hard onboarding people through Zoom, which requires interacting face to face, learning from your peers and your seniors, and so forth. There were some companies, however, that did actually benefit from this last challenging time period. Logistics companies, for instance, who were forced to bring more and more product to people where they were, not just the Amazons of the world, but a lot of smaller ones have done incredibly well. And they're a bright spot actually in the office landscape. I just read an article yesterday that several of them are expanding rapidly within the Chicago downtown, getting 40,000-foot offices in Class A office space. So they're one of the few kind of bright spots from an office standpoint in the traditional sense. While we've gone through this whole challenging time for office, much has been learned. It's accelerated the need or the wants of the employees to have a say in where and when they work. And but there hasn't really been a consensus on what the path forward is. Offices will play a role in not everybody, but in office workers' futures, clearly, but to what extent? And then how does that look from an investment standpoint? Will offices trade anywhere near where they did before? Or there'll be that appetite for Class A office space from a large investment standpoint? It remains to be seen. But we do know that devalued office assets weren't hit quite as hard as expected, and there wasn't quite as much of a panic selling or anything of that nature. It's more riding out the rough waters, pivoting, creating different kinds of revenue streams. For instance, many of the large downtown office buildings took some of their recently vacated floors and created floors of co-working that could benefit their own tenants within the building as well as outside tenants. If a company were to sublease half their space because they felt only half of their employees were going to be coming in, they may not have enough space within their actual confines to host company-wide meetings, to do quarterly sessions where everybody was all hands on deck. So they could use these co-working spaces from that perspective and supplement what they already had. It's Tishman Speyer, for instance, came out with a concept called Studio that they're putting in just about all their buildings. There's one in one of the Chicago buildings, and it's a whole floor of collaborative workspace. These types of solutions were needed to get some vitality back and get companies to better be able to utilize their space. Also, from a retail standpoint, there was definitely devaluation of the retail assets as well. There were quite a few bankruptcies. They needed those office workers to buy coffee sandwiches or even go to happy hour and have dinners after work. A lot of independent restaurants suffered, and we'll see how that bounces back. I think it will bounce back shortly. Just the momentum and the enthusiasm of the office worker and the tourist in some cases returning to the cities has been a bright spot. Just being downtown often, and I've been going into the center city of Chicago for 3-4 months now on a regular basis. Every week gets busier and busier, and that's a great thing. The question now is really how we'll bounce back, when we'll fully bounce back, will it ever be the same? And interestingly, the answers to those questions lie in new stakeholders and decision making when it comes to office commercial real estate. Originally, the decision makers in how much office space a company would take on for a lease obligation for an extended period of time was either the finance division or the operations, or most usually a combination of the two. In certain large firms, there was actually a role of head of real estate. But now it seems like these decisions are starting with the chief people officers or the head of HR, and then the chief technology officers as well, who are figuring out what kind of technology is needed to get employees to work at their optimal from wherever they may be, whether it's work from home, work remotely, or work in a hybrid model. And the hybrid model is the model that most companies that I've encountered have become really enamored with, and trying to figure out how to allow their employees certain flexibilities to work from home when needed, or when they'd like to, or at least a couple times a week or month, and then get office workers in other times as well, whether it's to collaborate or a big meeting. But to make this happen and to make this feasible, there's been new technologies that have to be invented and implemented. Anything from desk reservation systems to office reservation systems, which allow kind of a co-working style hoteling of desks within corporate companies as well. So that's become a big growth part of the tech industry, as well as the increase of flexible and co-working spaces by companies generally speaking, whether that's as a replacement to their traditional office space, making their traditional commercial lease obligation more of an expense that's controllable on a month-to-month or year-to-year basis, with a little bit more flexibility and growth or shrinking depending on their workforce. And a lot of the big players in that, the IWGs, Regis's, the WeWorks, they've tried to pivot as much as possible to become a little bit more flexible of an option. Some WeWork execs also spawned a company called Daybase, which gives people the ability to use underutilized real estate for a day at a time in suburban areas. And in companies such as Upflex that I've been working with as well recently, have come up with hub and spoke models where hubs can be put into flex office spaces to serve as a mini HQ in different areas. So if companies don't want to have all their employees coming into the city center all the time, they can have hubs in suburban areas, whether it's Oak Brook or Deerfield or Schaumburg, and have their employees still collaborate in professional, inspiring spaces without having to constantly go into the office, or even just work from an office space on the road, or while work traveling, or also just leisure traveling if they need to get in or leave town early on a Friday morning and check into a space halfway there so they can get their paperwork done. Those are all things that never existed before this pandemic, and coming out of it, they're becoming more and more prevalent. And they're really de-risking the way people are going forward, because right now, for a while, there was a bit of a paralysis on what to do next, because there were so many different options and no one knew the best course. So it became a big discussion between the HR departments, the tech departments, the finance department, and operations. And now it seems to me that the next 3, 6, 9 months will better help us understand. And to say the least, things are rapidly changing. But with the involvement of the tech firms, the big landlords, and the corporate decision makers from an officing perspective, I think we'll see a very interesting and new landscape going into the future. Those are my thoughts and experiences over this past several months, and I'd love to field any questions any of our participants here have about this kind of new frontier in the office world.
Thank you very much, Andy. We're going to hold questions until all three panelists talk. The next, Andy has a great background in being more creative on the brokerage side on top of his new role at Upflex and being more flexible in the office space. But our next presenter is another spoke in the wheel of real estate, and he is an attorney for Growth Law, Bill Price. He's going to give us some background on EB-5 with a lot of experience on the legal side, both from securities, corporate governance, real estate, project finance, etc. He really has a wealth of knowledge that he can provide. But very a hot topic is this EB-5, and I even have a client right now who she's working with a lot of immigrants, and her business has exploded recently as a consequence. So I look forward to hearing what you have to say, Bill.
Thanks very much. I'm going to try to be brief. Lawyers, when they say that, of course, are lying, but I'll try to be brief anyway, because otherwise Bill Caden will kill me. And so, I got to be nice. Moving forward, EB-5 is one of my topics. The other topic is a couple of other things I've seen a lot of clients picking up on and doing in this current real estate environment, basically as they're raising money, which is what EB-5 comes in with. Now, let's see. We are supposedly here from the beginning. And frozen. Here we go. Okay, I finally figured out how to make things move. The EB-5 status, despite all rumors, they're not dead yet. It's a Monty Python quote. So what were the changes? Bering Regional Center versus Wolf is a lawsuit which invalidated the Trump USCIS rules, which increased the amount of money you had to put into an EB-5 deal. So 1 million is again the minimum investment that is allowed for an EB-5 visa, except in a targeted employment area. The targeted employment area, these are designated by the states, and there's some in every state. The minimum investment is again 500,000 instead of being up. People are able to make these applications. There's no restrictions on them. They're processed, but remember, there's only 10,000 EB-5s every year. So you basically have to line up your money, line up your deal, get everything ready, be ready to commit, and then you go through 1 or 2 years of processing to go through whatever process, whether it is a lottery or a first come, first served. USCIS has changed its mind 3 times in the last 2 years to see what order you go through. In general, the earlier you get in, the earlier you get out. What Congress failed to do on June 21st is reauthorize the regional center program. Now, regional centers for EB-5s were projects or project organizing groups, all kinds of different areas, not necessarily just targeted employment areas. Minimum investment was 500,000, and they were able to offer a lot faster processing. They didn't take a 1.5 years at USCIS. They got pre-approvals. They worked their way through the system. Congress is likely to reauthorize that program later this year. What USCIS is doing on the EB-5 as a result of the regional center failure to reauthorize is as follows. First, those who got in under regional center applications earlier, and so are in the course of the 2 years after their tentative visas were granted, can still apply to remove the conditions on their visas. Their visas are ineffective. Similarly, no other applications besides regional center applications are stopped. Everything else is live. They are going through, they're processing applications. On regional centers, no new centers can apply for certification. No new regional center-based project visa applications are being processed. And the ones that are in the system are basically just on hold pending congressional action. Congress has failed to reauthorize before. They always did reauthorize, and I think they will again. But knowing what Congress will do is sort of like knowing what the stock market will do. If you know it as well as anyone else, it will make you Speaker of the House. There are alternatives to EB-5 for bringing money in. If you have an operating company outside of the US, you can bring an executive over on a B visa, which is usually up to 6 months. But if you need somebody longer term, you can bring them in as an executive under an E1 visa. This either means extraordinary talent or it means that you're in business. Business people don't have to be talented, they just have to be employed by a company outside the US and paid by that company and have employment with them beforehand. Similarly, E2, treaty trader investors, can come in. India does not have a trade treaty with the United States, which I think is weird, but there it is. They've tried to work it out every year and they haven't yet. Pakistan does, and about 90 other countries do. These are long-term visas. A person can live here basically indefinitely while they have a business here, and the amount of money is less. USCIS has let these visas happen for as little as $330,000 investment. You just have to show a viable business plan and show the business is going to be here. Next, couple of short comments on how people are raising capital. One is a business entity type that not everyone knows about. The other is a reminder, whether you're doing an EB-5 or an E2 or anything else, the securities laws at both the state and the federal level apply. So first, how do you structure your deal? Everyone used to use limited partnerships. This started mostly back before the Tax Reform Act of 1986, but people have kept that structure. You can do the same thing with a few other advantages in a type of entity called a series limited liability company. The entity, and this can be done as an Illinois entity or a Delaware entity registered in other states or otherwise. I tend to use Delaware because you don't have to pay a new fee to create every new series. Each series of the limited liability company has separate liabilities and assets from other series. So it's not just different series of stocks. This can be a separate entity if you want. So each series can have a different employer identification number, or they can all report taxes together and still separate their liabilities and assets. You can have different investors, different kinds of tax treatments for each. A lot of people just put building 1, series 1, building 2, series 2, building 3, series 3, and so on and so on. You set up a management series to manage all the others, and this acts pretty much like a corporate general partner. But again, you don't put your personal assets at risk, and it can be within the general partnership structure. Managers can structure their compensation in a way that fits, and partnership law allows you a lot of flexibility in this. So you can use carried interest to get capital gains from ownership in the project. So when the projects sell out, you get most of your compensation, and it's given a capital gains tax treatment, which is advantageous. Securities laws. The definition of securities fraud, and this is in every state law and the US Securities Exchange Act, it's failure to disclose all material risks to investors before you finally accept their investments. So what is a material risk? It's anything that could adversely change their returns. So anything that a rational investor could and should consider. Somewhat squishy. There is a FINRA notice 10-22 you can look at, which suggests the due diligence standard and suggests things broker-dealers should look at whenever examining a private investment. And that gives you some idea what kind of documents to pull together to be able to answer their questions. Third-party funds escrow is, however, allowed. So you can have investors apply to invest. Their funds don't disappear. You ask them to apply and attach a check, but you put that in an escrow fund, just like you would if you were going to do a closing, and you hold it until either you close or the investor changes their mind after receiving the disclosures. And obviously you put a time limit on the time that they can think about things. so that you know when you have that money or you don't. A private placement memorandum is one way to document all of this information. On smaller deals, another method is what's called the big pile of documents methodology. That is, you just get all your plans, all your financials, all your surveys, all your contracts, everything else. You provide them to investors by a traditional method. You get an online Dropbox and you just stuff all those files in there. So what you were going to be looking at anyway in your team, they can look at. They can see everything that you can see. They've seen everything that you decided on when you were going through, and they see the new stuff as it comes in. Now, the one thing you've got to do is prove they received this information, and you make sure you've got a risk list that they know and they've signed for. I usually stick it right in the subscription agreement to make sure that they know they've received all the material risks. So, for instance, they are at risk of receiving bad country music song titles if Bill Price is chosen as a lawyer on the deal. I mean, it's a bad thing. They keep telling me, how can I miss you, Bill, if you won't go away? Well, I will go away shortly. So if you got any questions at the question period, come talk to me. And I'm turning you over early, I will note, to Bill Caton, so we'll stay on time.
Thank you very much, Bill, for that presentation. And as he said, we're going to save questions for the end. I certainly have a couple questions for you, including what's considered extraordinary talent. So if you would like to contact Bill, have questions after, go ahead, ask him. Also, you can reach him at growthwa.com after this presentation. And then our next presenter, Bill Caton, he's the managing broker of Caton Commercial in Naperville, Chicagoland area. And he has over 40 years of experience. He's a wealth of knowledge, has a lot of interactions, real estate transactions globally. And so he's going to cover everything that we haven't covered so far in hot topics in commercial real estate. So go ahead and take the mic, Bill.
Oh, well, thank you very much. In the next 10 minutes, then I'm going to fill you in and all the gaps, okay, in commercial real estate asset classes that they haven't covered. Good luck with that, okay? But I do have some high points, all right, that I actually thought that I understood where some of these asset classes were at. But as I was doing some additional reading, found that I was behind the times, because in this fast moving market back into this post-pandemic world, things are changing at a rapid pace, okay, on a weekly, even daily basis. So I'm going to rely, and you're going to see me read some of these because there's some, to give you the sense of that change, you got to understand some numbers, because that's what comes in play. First, in the office market, I'm not going to take a lot of time here because Andy did a really good job of, explaining the hub and spoke and the changes that have occurred in that area, except to say that the vacancies, okay, are still out there, but they're rebounding tremendously fast on a national level. New leasing volumes, there's over 80 million square feet was leased in the second quarter. Okay, that exceeds the first quarter of the 2020 pandemic. So you can see we are rebounding, but where is it rebound? Mostly tier 1 cities, mostly mega tech firms. So they're expanding their real estate footprint, okay, after all these. And we're talking about Facebook, Amazon, Apple, and Google are taking up huge amounts of space, 70,000 square foot spaces in 6 buildings recently in the area of the Sunvale, California area. However, when you get to the secondary and tertiary markets, okay, the scene is not quite as robust, okay, or as encouraging when you look at that. However, citywide, what they're finding out is those cities that have a high number of remote friendly jobs, those markets aren't recovering as fast as other jobs, okay? Specifically Chicago. It was interesting here to see that Chicago is the only major market, okay, that we see an increase in the demand for office space in May. So that says something about the opportunities that exist here in office space. Industrial, what can we say? They have been the ones that have actually won the lottery, okay, during this time. They have never stopped a beat. Okay, they are moving at lightning fast pace. One could ask, are they, have they reached their peak? Have they topped out? Are they going to go into the recession period? And it doesn't look like that. Industrial space is sitting to set records sales here in 2021. And we can see that May over May, and this is nationwide, the US industrial market is up 16.3%. This was over May in 2020. So the market is still expanding. There are more square footage of industrial space being spec'd right now than we can absorb, okay, in the next 3 to 4 years. They're predicting that this will continue, this building of spec space in industrial areas all the way through 2026. Okay, so the industrial people, okay, have really done well. They're shattering these records this year. They're looking to exceed 30 million square feet in the last area. Leasing by the total square footage was up 30 to 40% in the quarter from the previous pandemic, last quarter. So stronger than many of the largest US markets can even handle, right? And we're seeing a little bit of that. Builders set quarterly records in the amount of space under construction. We talked a little bit about they're surpassing 400 million square feet in the second quarter of this year. Buying is also investment in this area, okay? Next to multifamily, the investors are seeking, okay, the industrial sector as an investment. So the key takeaways are the industrial area is doing very well. National average rents, okay, are reaching $6.59 per square foot. National vacancies are at 5.7%, and now that ranges anywhere from 2% in the Inland Empire, okay, to 12% among other markets, okay, like San Francisco. There's 456 million square feet of new industrial space in the planning stages we talked about. So Southern California, these are some of the areas where we see a lot of this, okay, increasing going on. Also, there's great synergy and momentum in Dallas-Fort Worth and Chicago. Chicago ranks right up there as some of the largest under construction totals, okay, in the United States in terms of starts. Industrial investments, okay, up 115%, okay, in year over year comparisons from 2019, okay, May over May. So there's industrial. We know that they were the great recipients of the lottery during that. In the multifamily area, another sector that's been doing very well. It had some, dips during the middle of the recession. Rents, were sagging and vacancies decreased. They too are, however, are rebounding much faster than was expected in the area. Rent growth in Chicago, even though it is maybe on the slightly low area at about 1.5, it is rebounding, and that market is coming back. It's like we expected it to, but maybe a little bit sooner than that. The averages for Illinois is around 4.8%, and that compares to the USA at about 8.4%. So you can see that Chicago's lagging a little bit behind some of the other tier 1 cities, okay, in that area. Investments, okay, the top investment areas for cities in investing in multifamily. Okay, they have a list of these. I found it interesting, and that is going from Phoenix, okay, at number 1, Atlanta, Charlotte, North Carolina, Austin. Austin's always been in there, Texas, Raleigh, North Carolina, Nashville, Okay, of course, there's a market at the top. Tennessee and Tampa, Florida, right, is where the investors are going in that area. So multifamily is also doing fairly well. Everyone knows that hotels and retails really got hit, right? They were the recipients of the strongest declines during the pandemic. However, they are also coming back. Hotels are within 10 basis points, okay? When we look at the June 27th to July 3rd comparison, okay, the rates, okay, of daily rental rates are up an average of 5.8%. So it's costing you more to make that overnight stay at your hotel. Although gross operating profits, the industry is still, sagging in that area. They're now about 70% of revenues of what they were in 2019, but coming back. Many hotels are still financially in difficulty, and they were seeing issues as evidenced by the stagnant rate and the labor cost, okay, and the labor pool out there. Retail sector, interesting that is also coming back. Okay, we've had a lot of closures, and there's headlines that I pulled up articles here that 1/3, okay, 33.6% of all small businesses closed during the pandemic in that period of time. But the shoppers and the consumer confidence has been high. There's been trillions of dollars pumped into the system, and people are out buying. When you look at indoor malls, okay, they were down just 8.1% in June compared to 2019. I mean, who would have thought that? I mean, that was surprising to me when I looked at it. But it came back very quickly, because in April, it was down 15.7% over April in 19. The outdoor malls, including lifestyle centers, they're only down 5.6% in June compared to June of 2019. So that rebound, okay, people, getting out and going back to shopping and getting into shopping malls is really creating a rebound in that market. Major retailers, okay, of course, you read all the time about the closures. There's 12,000 locations that were closed in major retailers in 2020. They're looking at the small businesses. I told you were down about 1/3. The e-commerce, okay, from 19 to 20, okay, is up from 11% to 14%. Doesn't sound like only 3 percentage points, but that's a huge shift in consumer dollars, okay, that create a whole set of conditions in the marketplace in terms of warehousing and transportation and industrial, okay, and so forth. Retail is rebounding, and it is changing because of two things. One is, the technology that's occurring. A lot of retailers are rethinking their business models, and they're doing things, okay, that will bring people back into the store, such as having more experiences in that area. So the major cities are doing well in the rebound, but the secondary and tertiary markets are still lagging behind in that area, in the retail area. So those are some of the things that we could, look at in terms of where we're at in the marketplace. Everybody's talking about, the microchips shortage and the supply and lumber and steel and the impact that that's having, because when we look at the commercial sector, it is still driven by rooftops. That's an old adage. It's not going to change. And whenever you look at lumber prices that have skyrocketed over 400% in the last 16 months, where a 2 before 16 months ago was around $2 and now is well over 10. Okay, these are having their impact on the building industry, okay, in that area. So you put together the building with the shortage supplies and the coupled with the increased pricing of land means that buyers will see higher prices, okay, as they move forward. And not only the residential market, but in the commercial market. Teresa, I'm going to turn it back to you. That was a very quick couple topics.
Thank you very much, Bill. So what we're going to do from here is a question and answer session. So feel free to either raise your hand or put your question in the chat if you have anything. I know I have a few questions that I would like to ask that I think will be helpful. And then after we're done with questions, we will turn the recording off. And if you want to stay on and talk about some of your needs and wants, and or what some future presentations that would be very helpful for you, that would be really great. So I am going to start, actually this is for all the panelists, and then I have a more specific question. So for all the panelists, I guess to kind of summarize, what do you think is the two sides, the biggest opportunity for commercial real estate practitioners and what the biggest risk is? And then I do have a more specific question for maybe Andy or Bill Caton, talking about, for example, office space. So one of the things that we're seeing, certainly in Chicago is one day away from 50% of the US population. So we saw a lot of industrial growth here, but we're also seeing more leasing in office space for those logistics types companies, as well as some other tech companies. So in that office space, how much do you think will actually be occupied and by who? Or will we continue to see some vacancy that will have to be repurposed? So, you know, if Andy and or Bill Caton, if you have some thoughts on that.
Sure. To answer your first question about the biggest opportunities, I think the biggest opportunities right now lie in the adoption of new technologies to help facilitate anything from tracking occupancies to helping out apartment dwellers to even retailers better understanding, you know, foot traffic, things like that. Our industry has been slightly a laggard compared to some others when it came to adoption of technology, but I think because of the drastic changes in a short period of time, that is changing on a daily basis. And I think now it's very important for people to keep up and basically not get left behind. I think that really is the biggest thing. As for your second question about kind of the office usage patterns, I think there's always going to be a need for office space and headquarters. There always needs to be, for any company of a certain size, there needs to be that place where they can, you know, meet their new clients, train their employees, collaborate as a team. And I think what Chicago has as an advantage, it's one of the few cities in the country that doesn't rely on any several specific industries as our backbone. I think there's no one industry in Chicago that occupies more than 7% of our space, as unlike other markets like San Francisco, which are super tech heavy. That being said, it can absorb these kind of scenarios a little bit better. And to Bill's point earlier in his talk, you know, there has been an uptick in interest in office space here. So I think the biggest question mark or the biggest variable though is how all this subleasable space is going to pan out, because many companies put, you know, a collective million, you know, several million plus square feet of subleasable space onto the market. And are those spaces going to get gobbled up, and who's gobbling them up besides kind of logistic firms like you mentioned? You know, who's growing exponentially? That's a tough question to answer, and that's stuff that'll need to be tracked. I just really see more of a distributed workforce kind of model where there'll be multiple offices, people will be more flexible, but you know, that's my own personal view. And I think that it should pan out quite well in these kind of markets like Chicago that have I guess an interesting other fact to add is Chicago has more than 50% of its office space in the suburbs. It's one of the few cities that is so geographically dispersed. And if you think about it, you have what, 3 million people, Chicago proper, 7 to 9, depending on your boundary lines, if you include all the metro area. So just from those numbers alone, you have to keep in mind how many suburban office opportunities there are. So I think that's going to be a very interesting part of the market to watch from an investment standpoint. If there really is kind of a little bit more of a shuffling the deck redistribution of where people will be working on a regular basis.
Mm-hmm. What about you, Bill Caton? What are your thoughts?
To add to that, just there's been this migration to the suburbs, and the office suburbs market has been extremely hot. And there's prediction that that's going to continue or not. Okay, so that's we're going to have to do a wait and see on that. I don't have a crystal ball. I do believe that there's a certain segment of the especially the tech industry and so forth, that want to attract new talent into their businesses, that will want to move back into Chicago Center. And so we're going to see kind of a roller coaster ride between the suburban office and the central business district offices as to, you know, where are the people moving and where are the investment dollars going in the future.
Thanks. Bill Price, obviously you came in with a different perspective on the legal side. What are your thoughts, especially per your topic, in the legislation, where the biggest opportunities are and the biggest risks are?
Well, I have clients and I've seen demand for new money for real estate projects and funds in Arizona, Texas, Atlanta, Georgia area, and in Illinois, oddly enough. These would all be places where there's a fair amount of suburban space to spread out and build new buildings and do new things. The demand is generally for enough money to pay for a down payment, because loans are still the cheapest way to fund anything, but you can't get a loan without a somewhat higher down payment nowadays. So you need that equity component. And that's where the EB5 comes in. Other international investors continue to be interested in the USA.
All right. Does anyone else have any questions for the panelists or for the group in general?
I see that there was a question that came in through the chat about booking spaces using a smartphone app. And the answer to that question is yes. Through the Upflex platform, you can use both an Apple or an Android, and the app's very user-friendly. Basically, it's a map, and you can book spaces globally. Over 1,600 plus cities are on it, over 6,000 spaces virtually. And these are all brands that that are either global or regional or local, but they're all serviced office centers, meaning there's a front desk person, there's all the needs that you might have for an officing day, you know, anything from a copier, etc. And they're accessible at your fingertips for both private desks, private offices, and or meeting rooms.
Thank you very much, Andy. Any other questions? I did not see that in the chat, so you must have received that directly. So if there's any questions that you sent to panels directly, I do not see that. So raise your hand or type it if you have any other additional questions before we end the recorded portion of the session. All right, and then among the panelists, did you have any final words of wisdom that you would like to impart for current participants, as well as, since this is a recorded session, that may be helpful for other real estate professionals?
Just one
Go ahead, Bill.
correction. EB1 as opposed to E1 for international executives.
Okay.
I would say if you haven't seen the Counters of Real Estate Top 10 Issues for 2021, look it up. They count these down. The number one issue affecting real estate, they say, will be the remote working and mobility. And then number two is the technology acceleration and innovations. And three is the environmental, social, and governmental tipping point of our nation right now. And then it goes all the way through logistics, there's political polarization, there's adaptation, there's capital markets. Very good report. You can find that online if you just Google it.
Thank you very much, Bill. Anything else, Andy?
Yeah, I would just like to add that as you know, leaders in the commercial real estate industry, everybody on this call, as long as you're healthy enough to do so, I recommend getting out and about as much as possible, and then being leaders in getting everybody back up to speed, going to retail centers, you know, using offices, and encouraging others to do so. And what I've noticed just from being out and about is that people are more interested in engaging in conversation and sharing and just being very social than they were before the pandemic. I think
And
there's
putting their phone down, right?
Exactly, and putting their phone down. That's true. There's some kind of rudeness factor that kind of disappeared with busting your phone out during a conversation. I haven't seen that as much lately. So good point, Teresa. So no, I'd love to see you all out in person too, and share a laugh and some conversation.
And then if you are listening to this presentation now or later, hopefully we'll see some of you at C5 in New York City at the end of September. And then again, we will be at NAR in San Diego in mid-November. And of course, always welcome to other opportunities. Feel free to contact any one of us, post the recording with any questions about commercial real estate, the presentations. I see Ahmed has a question. We also have this on a monthly basis, so we are open to discuss various global real estate topics. Next month will be about Canada. I believe Ahmed had something else that he wanted to add to the recording.
No, nothing to add. I have a question. Thank you, everyone. Great panel. Bill Price. So are we in a state of limbo, or where do we go from in terms of the EB5?
Well, regular EB5s are being processed, no change. Basically, we move forward. Regional
Right.
centers, we just have to wait until Congress gets its act together.
Right, but as far as the reversal on the regional center investment,
That's basically the congressional. They just didn't renew the law. They've done it before. They've always renewed again within the year. Congress, in its infinite wisdom, proceeds very slowly with its debates, but usually they get it done within a fiscal year.
okay,
So I suspect they will reauthorize regional centers, and I don't see major changes in the regular program. And since it was Trump administration people just trying to kill all kinds of immigration, I don't anticipate that the current administration is going to try to go back to the higher limits.
okay. Thank you, Bill.
Great. I would like to extend a thank you to Ahmed for organizing these presentations every single month so that we can talk about various real estate topics, particularly on a global scale. Thank you to Andy, Bill, and Bill for providing your insights. And looking forward to hearing what everyone has to say after this. I am going to stop the recording now.
One
so we
one
can
last
have-
thing, Teresa, sorry to interrupt, but as I spoke about meeting in person, I forgot to mention that on July 29th, NICAR, along with NASBAR, will be hosting a celebration on our strategic merge at the Butterfield Country Club for an afternoon evening of networking. So that's on the 29th of July. Anybody who's interested in finding out more information, reach out to one of us and we'll provide you the details to sign up. So I'm sorry about that.
Well, and then one other option is tomorrow night, there's a CCIM event at East Bank Club in downtown Chicago. So that's also another opportunity.
Awesome.
Great.
And thank you, Teresa, for a great job moderating. Thank you again, Ahmed, for organizing. Bill, thank you as well for your participation. Great stuff.
Thanks.